I think we should probably make a start. So welcome everybody to tonight's webinar. Thank you so much for logging on. We'll be discussing some of the ins and outs of common property related questions with our expert panel. Whether you're interested in entering the market for the first time or investment properties, expanding your portfolio or planning for some big life events that might be coming up, I'm sure that the insights that our panel will be really valuable to you. This is a part of an educational series that we're doing. There's already been a couple of webinars in the series, so please go and search those out. They are also under the banner of Finance Matters for Female Doctors. My name is Erica. I'm an associate in the Avant Law commercial team, which is Avant's subsidiary commercial law firm. I'm going to be a host for tonight, and I'm really looking forward to hearing from you all as well. A little bit about Avant. So Avant has been around for about 100 years. It's been supporting our doctors with insurance needs for that time, but you may or may not know that recently it's diversified into other areas as well. Some of those areas include the commercial law firm, which I'm a part of. We sort of deal with some of the legal side of property matters relevantly, and then a broad range of commercial law needs. And then Avant Finance, which deals with supporting doctors with their finances, whether it be property related or other sorts of loans and financial products. Two services that we definitely don't offer are property agent services and any sort of accounting. So the relationships that we have with people like our panel are really important to us. I will let each of our panel members, Maddie, Kelly and Kim, introduce themselves and a little bit about what they do before we get into the questions. Maddie, do you want to go first?
Sure. My name's Madison Bonner. I'm the co-owner and director of Bywell, which is a wires advocacy agency based in Brisbane. And more broadly, we service Southeast Queensland. So anywhere from down the Gold Coast all the way up to the Sunshine Coast and sort of out towards Ipswich. I've been in the industry for many years, and we've been experiencing some really interesting changes since COVID, and I've been asked to give a little bit of backstory as to what a buyer's agent does, because I know it is somewhat of a new concept in Queensland in particular. So basically very similar to what a sales agent does, we sort of sit on the buyer side of a transaction and look after everything that a buyer would potentially need from that side. So we sort of take things off from where Kim and Kelly would get you on track, setting up a more broad financial structure and budget framework, and then we take it from there and put together a strategy for what your property purchase might look like, doing the due diligence, going out to the market, sourcing properties for clients, and finding, between 75 and 80% of our properties off market. So there's a lot of transactions that are happening before they've even reached domain or realestate.com. And then we take our buyers, our clients through that transactional process all the way through to settlement and then onwards to property management as well for the investors. That's me.
And you have a bug on the way.
And I've got a baby on the way, so excuse any baby brain that I might experience during this webinar. I've got these guys ready to catch me when I
My name's Kelly Chard. I'm an accountant and my firm is called Growth MD. So we're based here in Brisbane, but we look after clients all over Australia. We deal only with medical professionals, so doctors and some other health professionals and health businesses. And because doctors love property, we do lots of property transactions. So looking forward to hopefully answering a few of the questions you've got for us tonight, Erica.
And I'm Kimberly Chi. I'm one of the brokers here with Avant Finance. I have a 2-year-old that keeps me busy. But yeah, I love property and helping our clients deal with the finances of things when it comes to achieving their property goals. So yeah, that's me.
Perfect. As the lawyer in the room, I think it's probably up that I take the disclaimer. So there'll be a disclaimer slide that comes up on your screens now. I won't read it out to you, but the general gist is that property matters are incredibly specific and they need to be tailored to individual circumstances. So don't rely on any of the general advice that we provide tonight, but if you would like to discuss any of your personal circumstances, then our details will be available after, and we'd love to discuss those with you further. On that note, I think our attendees are probably here, obviously with an interest in property matters, but also cognizant of the fact that every time you bring up something property, it feels like everybody has something to weigh in about. You know, there's so many people trying to talk to you about it. Why do you think it is that property is such an enduring part of like our lives and of medical professionals particularly?
Yeah. I think, as Kelly mentioned earlier, doctors love property. And I think that whether it's because the property market's so hot at the moment, both interstate and also in Queensland right now, or whether it's because there are just so many success stories out there that you hear about, ultimately property is it's an asset that's tangible, and it's also versatile in being able to help a doctor with building their wealth and just making their money work harder for them. So doctors are also recession proof when it comes to their income. So they're able to generally ride the waves of the property market, whether it's the ebbs or the flows, whatever it may be. So yeah.
Yeah, and I think you know, property in general, it's such a popular conversation, particularly, you know, within our Australian culture. It's so ingrained in our Australian culture. We were just having this conversation earlier. You know, whatever restaurant you walk into or cafe, you know, it's an Australian pastime on a Saturday morning to go and pop in and see a few open homes or have a sticky beak at a few neighbouring sales from your house. And I think that's why, you know, and it's such an interesting space because it's something that people have a really personal connection to, but it's also something that is obviously a fantastic investment. And Australian property market more broadly has had such a sustained period of, you know, stable growth when compared with other countries, I think in particular. So it's a really common conversation that people are having, and I think it's even more poignant within the medical community. You know, as Kim was saying, it's something that doctors are constantly having conversations about. It's something that everyone's really interested in. So I think from that perspective, you know, it's just something that people are always going to be talking about.
Yeah, look, I agree with you both, and I know our clients tend to love property, so our health clients, and I think it's because it's tangible. I think because it's talked about a lot, so there's a bit of FOMO that goes on in that, you know, you see other people talking about properties that they've bought or sold and made a great gain on. So I think that a lot of people are interested, and I think it's really, that's why it's so great that we're having this discussion tonight, so that, you know, more people can sort of decide if that's the right strategy for them.
So getting into the specific questions, these were formulated based on questions that you submitted and individual topics that you indicated that you were interested in. There were a lot of questions that came up, but these are sort of some of the most requested topics. If there are any questions as we go, feel free to pop them into the Q&A box, and somebody from Avant Finance will be in the background answering as we go. I think, Maddie, if we could start with you for the first question, and then anybody else who wants to chime in afterward. Whether it's in response to life events or market movements, one of the major questions that we've come across is the when to purchase a property. Is there a right time?
Yeah, I think, again, it's a really big part of that property conversation, is when is the right time. And constantly you're hearing those conversations about people saying, oh, you know, when is the property market going to crash? Or, you know, I'm waiting for this election to happen so I can see what's going to happen in the market, or waiting for interest rates to go down or the bubble to burst, all those kind of commentaries that we hear all the time. But I think, you know, whilst it's really important to have a clear understanding of how those kind of macro features will play into the property market, I think it's probably more important that we look to historical data, and that's certainly something that we do as property investors ourselves, but also for our clients. You know, COVID's a really good example of that, where you know, you kind of look to those future predictions of market performance, and we had so many panicked buyers and sellers that were, you know, not trying to enter the market or trying to, you know, pull out of the market during that period of time going into COVID, because they were anticipating all of these, you know, ginormous losses. And of course, the property market did the exact opposite. So I think from our perspective, you know, that's something that we really shape our client strategies around, is looking at the historical data. And it's really important, of course, to have an understanding of what the property market and the general, you know, typical property cycle will do, because of course there's going to be peaks and troughs and plateaus across, you know, 10-15 year periods, which is typical, but it's better to look back on that 10 to 20 year historical data, and then you can really map out what those investments, particularly asset classes and particular areas, are doing over those periods of time, rather than guessing, you know, what the future may hold. In terms of actually answering the question, I think our advice to clients is, you know, is to buy now, buy when you're ready. Again, you can't predict what the market's going to do. You know, potentially interest rate environments might change, and you may not have the same capacity to borrow, even if prices are coming down. So there's a number of different factors to consider. So what we typically say is the most important thing is just time in the market rather than timing in the market, and generally just staying in that market to see out those property cycles is really important, and not responding or reacting to those more macro features that might have small you know, peaks or troughs at any given time. It's the longer period of time that we're really more concerned with.
Yeah, absolutely. So when people ask me if it's the right time to buy, I say that is not my thing. That's when they have to come and speak to you, Maddie. And I guess I take this question then from, is it the right time to buy in life cycles? So a lot of people are like, am I too old to get into the market? Am I too young? Should I be doing something else instead with my cash? And I think that there is reasons to be found for people at any life stage entering the property market, whether that's younger doctors that have maybe just started earning that higher income and looking for tax deductions, whether it's people looking to invest for the future for their kids for housing affordability, or whether it's, you know, retirees wanting to self-fund retirement. So there is a lot of different reasons to get into the market, and I totally agree. You know, you're not trying to play, you know, a guessing game with the timing and, you know, that sort of thing. It's a well thought out strategy, and to suit, you know, where you are at your point in your life.
Yeah, I think there's no real answer to, is there a right time? It's more so like, can you be in the best position you can be to pull the trigger on buying property? And I think that comes down to, you know, doing your initial inquiries, establishing the relationships with key people such as Maddie and Kelly and myself, and also a good solicitor who can review contracts and things like that for you. It's knowing what's available to you in the market. You know, with you guys as medicos, you guys have niche policies available, things like going up to 95% without lender's mortgage insurance being charged, which is a huge thing. And I talk to clients all the time, doctors all the time, who don't even know that that's available to them. So it's just making yourself aware of those niche policies available, things like using future income to maximize borrowing capacity, and just having those initial conversations with each of us, and getting yourself in the best position that you can be in to be 100% ready, or close to it anyway, because it's almost like, you know, becoming parents. You're never going to be 100% ready, but it's just being in the most in the best position that you can be to prepare yourself.
Being as informed as you can be about,
yes,
about as much as you can be.
Yeah,
for sure. Yeah. Okay, next question is probably best placed to Kim first.
Mhm.
It's okay. So once a person or a practitioner has decided that they know their win,
Yeah.
where should they start with a property purchase?
Yeah, so continuing on from what I said previously about establishing these relationships with the key people, once you have those relationships in place, I think everything is just going to fall into place quite naturally and quite easy, and it'll alleviate a lot of the stress and anxiety that may come with buying a property. Basically, getting from a finance perspective, getting a pre-approval in place so you know exactly what's possible and what's not possible, what's in your price range and what's not in your price range. Because if you have aspirations to buy a 1.5 million property, but your borrowing capacity is only at say $1 million, you do have to manage those expectations. And you can't go to Maddie, for example, and say, hey, I'm looking at properties in the $1.5 million mark.
Although everyone does that.
Yeah. That's right. So it is the importance of establishing these relationships really early on so that you do know exactly what you're in for. Yeah, and again, it's just planning ahead, really.
Okay. Well, obviously, I think you should come and see your accountant straight away. Of course.
You don't like setting up trusts on Friday.
No. So the earlier you talk to your accountant about your structure, the better. No. So I guess in the same vein, it's all about planning. And so when somebody will come to me and say they're interested in a property, there's a few key things that we're going to go through first to make sure that you're set up and raring to go. So the first one would be, discovering why you're buying the property. Is it a property that's going to earn rental income? Is it something for your kids to live in? Are you going to live in it yourself? So that is obviously very important. Then having a look at your tax profile. So if it's something that you're going to be renting out and earning income from, how does that fit into you and your family or your partner or your own income profile? Then once we've got that, we need to look at some projections and some, work out how the tax flows on the property. And it's then that we start going, well, actually, maybe this is better in a different structure. Or, yeah, maybe you should buy it as an individual. You're going to get a great tax benefit here. Maybe you're a high-risk person in a high-risk occupation and you want some asset protection benefits. So buying it in a structure like a trust might be better. So we start having those conversations about, well, these are the pros and cons of owning a property in these particular ownership structures. And it's then, I think, when we have all those discussions, you sort of start understanding that, yeah, this is what I'm going to do. You've already probably talked to Kimberly about, how much you can borrow, and then you turn up with Maddie. And it's not like it sounds like it's a cross-selling thing. It needs to be, but, then you can go and you can, even if you're going by yourself, you can look for your property and know what your purchasing entity is, how much you've got to spend, and what you're looking for and what the cash flow and tax implications of that are going to be. So I think just getting all your ducks in a row is so important early on. And yes, the amount of last minute trusts that get set up.
I have the option.
Yeah. And it's very hard to change contracts and things. There's implications later on. So getting it set up in the right structure first and getting the contracts done in the right structure, very important.
Yeah, and I think to add to that, we're very much the last piece of the puzzle. But I think it's important to remember that there's strategy at every level, and it kind of looks different with each of us, I suppose. And once we come into the picture, you know what that budget looks like, then you know what your structure looks like, and you potentially already know what that asset needs to do. And then we kind of come in and find that physical representation of those goals. If you're looking for something that's high yielding, that might look like a house with a granny flat, or it might look like a townhouse or a duplex site or something like that. That is going to be that more income generating. Or if it's for tax mitigation purposes, it might look totally different again. Or if it's for manufacturing equity or that kind of thing, it could be a renovator on a larger block, things like that. So each property that you're kind of looking at for each different strategy will have a physical representation of what that is. And I think that's really important to remember, is not all property is built the same in that sense. It's really important to start with a clear focus, a clear strategy, and then we can kind of put the rest of the pieces in place.
Yeah, and I think what's really important to know as well is that having a pre-approval actually gives you potentially some leverage over other buyers who may not already have pre-approvals in place. Like I've worked with Maddie quite a few times with some of our clients, and her and Tim, and they've called me and been like, you know, if we're up against a competing offer with this particular property, is there the ability to negotiate on the terms? For example, going for a 7-day finance clause instead of a 14 or 21-day finance clause if you didn't have a pre-approval. It's just things like that, and that will help you.
Yeah, definitely being dynamic, and it definitely helps us having the relationship as well between us, and we can then workshop it and pivot really quickly when we need to in that negotiation.
Yeah, and also once you have all of your finances done with someone such as Kelly, it just means that we're able to communicate with each other and get all of the necessary income documents up front, so that we do know exactly what we're working with.
And as the lawyer in the room again, I'll tell you, there is a big difference between somebody who's done their homework, they know what they can do, they know what the limits are, and somebody who hasn't. There's a big difference in stress and often a big difference in time and money trying to undo something if it's been done wrong. So great advice to get it all sorted up front if you can. Kelly, I think next one maybe for you. So we hear a lot about specifically doctors and high income earning individuals buying property to mitigate or reduce their tax. Keeping in mind the disclaimer, of course.
Yeah.
Can you sort of speak on that for us?
Yeah, so of course, negative gearing is something that probably most people on the webinar have heard of. I'll give a very, very brief description of what negative gearing is, because that's usually what people are talking about when they're talking about tax benefits of investing in property. So negative gearing is when you have investment expenses, so say rental property expenses, that are higher than the income you're deriving off that investment. So expenses higher than rental income. So you're creating a loss for tax purposes, and that loss can save you tax that you're paying on your other income. So for example, if your rental income's $50,000, but your expenses are $60,000, there's a $10,000 differential. If you're in the highest tax rate, that's going to reduce your tax payable by $4,700 in that year. So that's just very high level. So that's usually what people are talking about, is a negative gearing benefit. And I think it is very popular with medical professionals, because we're usually dealing with quite high incomes and quite high levels of tax payable. And over the last 15 years or so, there's been a lot of tax loopholes closed for doctors and health professionals. So the big ticket items now are sort of superannuation contributions and negative gearing benefits, unless you're in business. So I think there's going to be continued interest unless something changes with our current tax legislation. The negative gearing benefit is going to continue to be of interest to people. And I guess the thing to keep in mind is I love tax deductions, of course, that's my thing. But the property is not going to just be about the tax deduction. So if we have a client come to us and say they want tax write-offs and they're going to do this property and blah, 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 I would want them to get advice and make sure that it's a solid investment, even without that sort of tax benefit. So, you know, a solid area, someone like Maddie could advise you, future capital growth, those sorts of things. Because tax benefits, you know, they tend to be good up front. Negative gearing tends to be really good in the first couple of years, and it does tend to peter out a little bit. And then when you sell properties, you have tax implications. So it's good to understand the whole range of tax benefits from start right through to sale, and make sure it's a solid investment all round.
Yeah, I think from the finance perspective, it's again talking to Kelly first about what exactly you're trying to achieve with buying an investment property, whether it's to reduce your tax or not. But from a finance perspective, then it's looking at whether you go principal and interest or interest only. To briefly explain the differences between the two, interest only is pretty self-explanatory. It's where you just pay the interest portion on the loan. So you don't pay down the loan balance as such. The loan balance will always stay the same whilst you're on that interest only period. Principal and interest, on the other hand, you're paying down the loan balance as well as interest on the loan. So with that, you're almost building equity with every repayment that you make towards the loan, because the loan balance is reducing as you go. So with interest only, obviously you are you're helping your cash flow, basically helping manage that cash flow and keeping that to a maximum, because with interest only, the repayments are going to be smaller than they are with principal and interest repayments. Generally, the rate is higher with an interest only repayment, but if you're trying to achieve that negative gearing benefit, then that might not really matter to you. But yeah, again, it's knowing things about what's available out there. Like, for example, gearing up to 95% can really help with that negative gearing, as Kelly talked about. Having an offset account as well, so keeping your funds in that offset account rather than putting it towards the loan to keep that that gearing high. So when it comes to buying your first home as well, and then having the long-term view of potentially converting that to an investment property down the track, that's when you probably want to keep that loan amount high, and have your savings in an offset account. So yeah, having that 95% can really be to your benefit. And as mentioned before, it just comes down to your overall strategy. So it is well worth a conversation with an accountant beforehand.
Yeah, and I think, I mean, I would probably agree with a lot of what you both said, but in terms of, I suppose, from our perspective, being the buyer's agent, tax mitigation is obviously something that's very much instigated by you guys, and I think from our perspective, it's just about implementing the right property purchase to kind of align with those financial goals. And I think this stage in the process is probably where a lot of this confusion comes from in terms of why people get into property, because I think depending on who you're introduced to first, whether that's your accountant or and what type of benefits they're seeing are the most beneficial for your situation, or generally whether that's depreciation benefits or negative gearing benefits, then that can very much be the lens that you then start approaching your property purchasing journey. But I think from our perspective, we generally sort of focus more so on the compound growth of the property over time, and making sure it's the right asset, that you've chosen the right asset, because I think the worst thing that you can do is go into a situation where you're choosing a property based on a strategy that might have been really important, say for example the negative gearing, and then the benefits are petering out, and then potentially it's not working for you after 3, 4, 5 years, and then you're in a position where you're having to then sell. And I think the important thing is to really, as Kelly was saying, is to know what those benefits are over the long term, because again, property is such a long term thing to do. It's not something that you jump in and out of, and it's not something you want to jump in and out of, because the cost of transacting is so high. The cost of transacting could be upwards of 12% on some purchases, with agent fees and commissions, marketing, advertising, your capital gains, all that sort of stuff. So you just want to make sure that you have a really, really overarching full picture of what all your benefits are and how that fits into your life cycle, so that you're not then kind of, you've achieved all of the benefits that you wanted in year 1, year 2, and then you get to year 5 and it's just not as beneficial as you might have thought it was.
Mm.
So I think knowing all of that going in is really, really important.
And I think you need to speak, well, my opinion is you need to speak to real people to get this
Yes.
advice. So I've seen so many TikTok videos with people giving the wrong advice, saying you can claim tax write-offs for this and that with property, which actually aren't true. So I think, you know, having trusted people that you can get the right advice from is pretty important there.
And they always, the TikTok videos, they make rent vesting sound like the easiest thing in the world. And so it'll work for absolutely everybody. So yeah, it's very important.
It's so true. Even in our industry though, there's so many different strategies that people can implement, you know, in terms of even, you know, that wealth creation over time. Not, you know, tax benefits aside, there's people that are spruiking certain satellite suburbs or, you know, a certain asset class, you know, certain things that we wouldn't necessarily recommend. I think it's just so important to remember that within each of our niches, there's probably a myriad of different strategies that are probably, you know, confusing everybody just as much. But I think it's, again, just coming back to that really specific advice for your situation and having all of that research and all of that information and a lot of anecdotal conversations as well. But be careful of TikTok and be careful of your family giving you unwarranted advice.
Always good advice. Okay, we are supposed to get into individual people who are listening in now. We have a lot of attendees who are going to be in different sort of stages of their lives. And I'm sure a lot of them are going to be interested in, you know, upcoming maternity leave, the possibility for divorce, things that nobody likes to talk about. And then some exciting things like further study periods or career transitions, maybe even heading into retirement. All of those are key concerns, and some of them are very specifically key concerns for women entering the market, or they're sort of seen as holding them back from building a portfolio and doing so aggressively if they want to. What would be your recommendations for alleviating some of that anxiety? Maddie, do you want to speak on that first?
Yeah, I think the thing that people get caught up in this whole conversation and the FOMO piece, you know, everybody's talking about property and everyone feels like they're getting behind, you know, and I think the important thing to remember is that you're not alone in having some of those elements of confusion going in. I think it's an interesting conversation because I think it's somewhere between 60 and 70% of Australians own property on some level. And I think, you know, that's really representative of people having the confidence to at least know what they want, and they buy a property and they move into it. And that's kind of the first step. I think where people then tend to get stuck is moving on to that second, that third investment property. And I think a lot of that is, I guess, changing the conversation. I suppose the conversation around leverage and debt and you know, property in general, it's always been quite traditional in the sense that, you know, you buy your owner occupied home, you move into it, and then you pay down your debt for the rest of your life, and then you've got this big chunk of money tied up in your house. And I think that was always the traditional mindset. Whereas now there's a lot more awareness and a lot more financial literacy around moving on to that second property, that third property, and creating an environment where you can then set yourself up for retirement. So I think in that sense, I've got some stats here, but it's like between roughly about 70% of, we've got really, really high home ownership rates in Australia. And again, it just comes back to that cultural piece, I think. But really, really quite high ownership rates in that first purchase. But then it drops off to something like, you know, below 20% for two properties of the population that own two properties. And then it drops down to less than 6% for your third. And then almost down to less than 1% for five or more. So I think from that perspective, it really shows that either there's something that's stopping people, or perhaps it's a view of leverage, or obviously, you know, there's certainly going to be income reasons why you won't be able to continue on. But I think with the right asset selection, you can continue to grow a portfolio quite comfortably, and particularly within, you know, the medico space, like the trajectory of your career will allow you to, over time, continue on that property journey if you're selecting the right assets. It's of course really difficult to anticipate those unexpected life events that are going to impact your ability to continue on. I think, you know, trying to dispel that fear around purchasing the second and third, you know, and getting those really traditional attitudes potentially from your parents, or, you know, the people that you're speaking to along the way that are sort of going, oh, you know, 2 or 3 properties, that's, you know, that's a lot,
Too much
you know,
debt.
too much debt, you
Yeah.
know, debt's bad. We get
Yeah.
so many clients who have that opinion around debt. So it's really important to just remember that you want to try and focus on people that have done or have already achieved what you're trying to achieve, essentially, in the property space. And if you can't find those people or those mentors, to reach out to people like us who can kind of really lay it out and put together the actual financial benefits of continuing on and what that looks like, and it's not as scary as people think it is. So I think from our perspective, to tie up my big waffle, in terms of managing your life cycle across your property investments, there certainly is, you know, a framework. It doesn't have to be as confusing as we buy our own home and then, okay, what do we do next? We like this area, and, you know, it's a little bit haphazard in terms of moving on to that next step. I think you can definitely put a framework around that, and something that we work with our clients around is it's much like, you know, when you log into your super account and it says, you know, when in your younger phases it's really aggressive and we're targeting all of these, you know, higher risk stocks. You know, in your younger years in property, it probably follows a very similar format. We would recommend doing things that are using your good debt, your mortgages, your secured mortgages, to leverage into further growth and manufacturing equity, and then transitioning as you get older into debt reduction, and then having the ability to either sell one asset, and hopefully not sell, to be honest, as well, is that you've set your portfolio up so that you can retain your assets and generate an income. It's not just, okay, we've bought this one property, we have to sell our primary place of residence to pull the money out to then retire, and then it becomes a stress trying to find where you're going to live in your retirement thereafter as well. So setting your portfolio up so that, you know, by the time you are transitioning into retirement, you've put all the pieces in place, and all of your assets are actually income generating for you rather than costing you money, or all your money's tied up in one place. So I think, yeah, it's just really important to remember that, you know, your attitude to risk and debt shouldn't be coming from necessarily your family. And you've got to have a really clear picture of what you're trying to achieve, and whether that's different from the people you're seeking advice from.
Yeah, look, I can totally understand that there is anxiety or concern or worry or barriers for people wanting to invest in property, because I think there is a lot of misinformation out there, and there's a lot of horror stories. And if you're thinking about investment, but you're also thinking about having kids or retiring or cutting back your work hours, you know, sometimes those things can be barriers. So from, I guess, the accounting side of things, there is things along the way that we can do to help manage those sort of life cycles for you. So, I mean, we have clients, and I work with clients from, you know, graduating to having babies to, you know, potential, you know, funding children through school, and then potential marriage breakdowns or divorces, death, caring for family members and having to stop work. So there is a lot of things that can happen in life, and having those investments at the same time, you know, these things happen. It doesn't mean that those investments cannot continue and you can't fund them all the way through. So some of the things we do, particularly say for maternity leave, so we sort of set up a plan for cash flow. We can look at varying some employer tax withheld deductions if you have rental properties, or looking at PAYG installment variations and things like that for self-employed people. When it comes time to look at maybe having properties for family members or funding kids and that sort of thing. There's some things we can do with trusts and distributions from trusts that sort of make the whole proposition more attractive, so that you can go through that stage of your life in funding kids through potentially trust distributions from property trusts. When it gets to, not when, hopefully it doesn't, but if it got to a marriage or relationship breakdown, there's capital gains exemptions and things like that. So there's a lot of help that is there along the way. So I understand that there is anxieties and there is barriers, but working with the right people can help allay those fears on the way through. And just on that, I think there is, I'm not a doctor, but I am female, so I do understand the concept of people maybe not giving you the best deal in a negotiation. And I think there is still, unfortunately, people out there that will hear that you're a female doctor and potentially not be honest about pricing, or you won't win that negotiation, or whatever that might be. So I do think it is important to get somebody in your court. So I recently bought a property and used a buyer's agent, and someone like Maddie can come in and help you negotiate, because even though I understand finance and tax and things, I do not know how to negotiate the best price on a property or pick which property to buy. That is not my jam. So I think you know, someone using other people can really take the stress out of that for you. So I guess what I'm trying to say is, get a good group of people that have your back, and then through those life cycles we can do things to support you and make sure that, you know, you're on the right course and that you know you're living out your strategy.
Yeah, and I think we sound like a broken record here, but it is really important to have these relationships in place that will help you, because we're all on your side. Like, we work solely in your best interests. We're not on the seller's side. We're not on, you know, any other side. And especially as a broker, as a specialist medico broker, we understand your income trajectories, your life stages, career stages, and everything. And it's our responsibility to convey that to the bank of choice. And that's also important. And it's where having a broker on your side can really help you, because there are so many different policies out there, so many different bank offerings out there, and it can be really confusing and also overwhelming for a very busy doctor like yourself. So I guess to answer this question, I'll just break this down into the different life or career stages. So the first one I'll start with is transitioning from PAYG to self-employed. So it might be after your exams, after your fellowship, you transition to maybe a mix of PAYG and self-employed, or you just go fully self-employed. A lot of people actually want to buy property at this point in time, just because their income really explodes during this stage. So it's important to know that when you do transition from PAYG to self-employed, your income structure actually changes quite drastically. So you're no longer on a salary. You're basically having to work for your money. So from the finance perspective, most banks, if you don't go through a specialist medico lender or a specialist medico broker, the banks will tell you that you need to have at least one or 2 years worth of financials or tax returns. And that's not the case for doctors. You can access banks, the health divisions of banks, that are able to work off short-term income, short-term income. So that means just having 3 months worth of invoices or BAS, or having P&Ls done by an accountant. So we can work with that. It's just important to know that you do have that 3-month waiting period. In terms of mat leave, so if you do have the ability to plan ahead for that, again, knowing what's available out there to you. So if you're a PAYG in the hospital system, generally a return to work letter and having enough of a savings buffer to cover your repayments during that time up until you return to work, that should fly with the bank. if they have a good mat leave policy. It's a little bit harder for self-employed, but not impossible with certain banks. And again, that's where having a specialist medico broker will be really beneficial. If you already have lending in place and you go on mat leave, you can consider asking your bank or your broker to organise an interest-only period so that it helps with cash flow during that mat leave period. So like I said earlier in the webinar, interest-only helps because it's a smaller repayment than a principal and interest repayment. In terms of divorce, I know it can be a little bit counterintuitive to be planning ahead as such for this, but again, it's knowing what's available out there and being aware of this kind of situation and what could be involved. So loan repayments while you're going through that divorce process, I know it can be lengthy and it can be not the best situation. Loan repayments is still expected to continue. So if you have a joint loan with your spouse or ex-spouse, you're joint and severally liable for the full repayment of the loan. So it does mean that the full loan repayment needs to be met rather than just your half. And in most cases, it's usually the medico who will want to take over the property. So we'll do, if you're planning ahead, it's important to do a borrowing capacity up front to know that you are able to actually take over the full loan with your income solely. In terms of retirement, this is a difficult one because everyone's in a very different boat when it comes to retirement. You know, you could be very asset heavy. You might not have a lot of debt by then, but on the flip side, you might still be very highly geared. So it just depends on your goals and what you want to achieve. Again, speak to an accountant or a financial planner when it comes to that. But again, planning ahead is good for that because once you are past retirement, lending is very close to impossible to getting. So yeah, planning ahead, I think, is the key takeaway from a finance perspective where possible.
Well, one thing I was going to mention as well, you said it earlier, Erica, like it was a dirty word, rent vesting. I'm sure it works. I'm sick of hearing that one that I talk about, you know. But yes, no, I just thought I would touch on that because it's an interesting concept and one that I think is kind of gaining a lot more traction. You're probably seeing it on TikTok a lot more than usual. But again, it's probably really tied into that whole, you know, deviation from those really traditionally held values of just buying your house, moving into it. And I think the rent vesting model does suit the, you know, the medical kind of trajectory, you know, whether that's obviously further study or, you know, the moving around or trying to get onto programs, changes in different, you know, income and that sort of thing. It can be really daunting to purchase a property and then you have all these big changes. And I suppose from, you know, that unexpected change or the plan changes, rent vesting can be a really good option to mitigate that and also to help you get on the property ladder, so to speak, much sooner. Because I think people are kind of often going, well, I'm going to wait until, you know, I get the job or get on the program that I want to be on and I'm making the money that I want to make. And for a lot of people that can be, you know, a decent way in the future. But, you know, there's all these fantastic lending products and ways to kind of jump in there earlier. And I think it's important to then remember, you know, if you can get some sort of finance earlier and put those structures in place earlier, there are property options available to you that aren't necessarily your dream home, but they are going to help you build a portfolio over time. And I think it's really important to just remember that, you know, your first property may not be your dream property and you don't have to sort of save up for half your career and then buy in when, you know, you're really good and ready. I think it can be fantastic to kind of do what you can now and look at, you know, potentially a cheaper option or something that you wouldn't necessarily live in and, you know, you don't want to move out to wherever it is. I don't want to say a specific suburb and someone living in that suburb.
Yeah.
But you know, looking at these other options that have really great capital growth, really good yield potential, and they'll also help you, because how hard is it to save, you know, a deposit, or you know, save for that beautiful home that you want in the future. If you can get on that property ladder, put together a smaller deposit now, and start manufacturing equity in an investment property that you can kind of put away, set and forget. You've got some tenants in there, and then you might be able to then either keep it, hopefully, once your income is increased, and just pull out that equity once again, or you could then look to on sell it and move into your PPR, you know, the one that you've really wanted.
There's also some tax strategy that can happen around there. So we have a lot of younger clients or non homeowners that will go and purchase a property and live in it for a period of time. They might move overseas to continue training. They might move interstate and rent. So they'll live in the property, move out of the property, rent that out for maybe 6 years, sell that property, and that property is still tax-free after all that time on sale. So there is different strategies around tax that might also fit in with different ways of investing and living your own life as well. So that's why you can't get all your information online. You've got to sort of sit down and work it all out and see if there's particular concessions or things that might be available to you.
Yeah. And that goes back to what you were saying earlier about time in the market instead of timing in the market.
Exactly, right? Yeah. It just helps you be in the market for such a longer period of time. And you know, even if you're looking at, you know, we've made a lot of great purchases for clients, even out towards Ipswich way, you know, and they're between, you know, 600, 700,000, still within that sort of affordable price range. Really good yields, and you know, at least over 10%, sometimes in some areas up to 15% growth per annum, which is super impressive, and it's just not a return you're going to see on your cash sitting in the bank. And that's really going to help you, you know, just to develop that that portfolio over time.
But I think we've touched a lot on sort of the scariness of property sometimes, and I think inherently, you know, there is something a bit scary about all the variables and all the unknowns, and we've also talked a lot about having the relationships with people that you trust and people that you know well and who you trust are on your side. I think generally a question for all of you just about, you know, some of the benefits that you've seen from dealing with people longer term, you know, like even just something that has been rewarding from your own careers potentially. I would love to hear about that. But I also wanted Maddie just to, for anybody who doesn't know, sort of go into a little bit further the concept of what a buyer's agent does. I mean, I'm sure that a lot of people have heard obviously about a fee for buying something, which is not, it's a newer concept than a commission for selling something. I've definitely dealt with a lot of buyer's agents over time, so I understand the benefit of having that sort of, I don't know how to describe it, but the person on the inside of the market. What would you say is the real value add of having somebody like your firm kind of in your corner before you start even looking?
Yeah, I think I mean, and again, it's not something I mentioned. You're so good at tying it back to your business. I love that. I think like from our perspective, we do specialize in and focus a lot on medical clients, and I think the common theme that we're really seeing a lot of is everyone's busy, you know, and I think as well it's you don't have the time, your hours are all over the place, you know, shifts and nights, days, things like that. It's almost impossible to develop rapport with real estate agents, which is often what you need, and you need to do it really fast in this market, and that can be really difficult to do. And I think that's probably one of the key features for us working in kind of the medical community, and of course as well, it's just that really short runway. You might see a property that launches on Thursday, you've got to get to the open house by Saturday, and they're calling best offers by Monday, and you're working that whole period of time. So from our perspective, you know, we get in there, we do a short list of options for people, people so that they don't have to go around and do all of that legwork or sit there on realestate.com waiting for things to pop up. You know, I might have touched on this earlier, but about between 70 and 80% of our transactions are happening off market as well. So there's just a whole heap of stock that you know, the average buyer just really isn't seeing. And I think that's why there's a lot of frustration in the market, is because they get posted once they are sold. And it typically does run through a buyer's agent. So I think from that perspective, we can add a lot of value in that space, just saving people time. We're doing the due diligence, you know, all through the weekend. We're always available. Most of our meetings are 7, 8 p.m. at night or on weekends and things like that, because that's when everyone's free, and that's, we try and accommodate that as much as possible. So I think from that perspective, you know, we can really save people a lot of time. And as well, just, you know, it's a full-time job, you know, looking for property, and no matter what industry you're in, you know, it can be a really full-time job. I know anyone looking for property at the moment, you know, you're doing your job, but you're also sitting there on realestate.com trying to wait for things to load, and you're doing your research, you're on flood mapping, hopefully you're on flood mapping. But there's a lot involved, and in such a short window. So I think from that perspective, it can be so difficult for people to lock and load, and then, you know, you might miss out on that one on the Monday, and then you're locking and loading again for the Thursday next week. And by the time you kind of spend, you know, what can really blow out to 3, 6, 12 months, which we're seeing all the time. And we get a lot of people that come to us and they go, oh, you know, I can do it on my own. And then, you know, 6 months later, they go, actually, you guys, you know, have any availability. So, you know, from that, I totally understand, you know, everyone thinks they can go it alone. But I think if you're busy, just lean into the help as much as possible. And we're here for it. And, you know, yes, there is a fee attached to that, but, you know, when you look at the time it takes you could be missing out on, you know, 10% capital growth on a property that you're not in the market for 12 months. And that's going to be a lot more than what we're charging, I promise you. So,
or you have to spend 12 Saturdays missing your kids' soccer games, which is also very valuable.
Exactly.
I was going to say, I've never met an agent that didn't genuinely love property, and while it's fun, sort of when you're looking for one for the first few weeks, then you're going, is it ever going to
and it's that heartbreak, isn't it? Because people go into the open house and they go, this is the house, this is the one, and then they miss out on the Monday and they're like, I hate this.
And over the past couple of years, we've also seen a lot of clients where they have wanted to do it on their own because they haven't really wanted to pay that fee to a buyer's agent. But then we see them extend their pre-approval 6 months, do a new application, another 3-6 months goes by. And by that time, prices of the house that they were expecting to buy back then has increased to 200K. So it's almost like what's more worth it.
We're right on 8, so we should probably start wrapping up. Did you want to add anything to any of the questions that we've asked so far, or you know?
I think I missed the first part of your compound question before.
It was generally about you know, creating relationships with your clients and how you guys value that. Obviously, you know, we're all in sort of service industries, and for a reason, I'm sure. It's because we like helping people, but you know, what are some of the benefits you've seen from those relationships?
I guess I just finish off by saying, you know, it makes me really happy to see some of my female medico clients that have great investments. They've potentially got SMSF, they've got trusts, they've got personal property, they're well funded, they're thinking about wealth, intergenerational wealth transfer to their families. You know, they're funded well, they've got the right rates, you know, they're getting good advice, they're tax efficient. So to me, that makes me happy because I'm a bit of a nerd, but no, but you know, I think it's very empowering, and I just love seeing that. And so I hope tonight we've helped a few people move towards that position.
Yeah, I think for me, my true passion is helping see junior doctors buy their first property and then seeing them right through to buying their first investment property, second investment property, and then building that property portfolio. And it is really rewarding to see a lot more junior female doctors jump into the market on their own without, waiting for a partner to help them with borrowing capacity and things like that, being independent and building themselves a good foundation.
Yeah, absolutely. And much the same. I mean, it's just about, and for us, I think buyers agents are getting a bit of a bad rap about being a little bit transactional, but for us, it's really about being on that whole journey, from that first property, whether that's we've helped a number of clients renovate that first property, manufacture equity, and then leverage that into a second property really, really quickly. And I think, being able to work with, a fantastic group of women like yourselves, it helps them get there much, much quicker. And I think that's really what it's all about, is just helping people sort of realize their dreams.
There is nothing quite like a well-oiled machine. And I guess we're all nerds in that respect.
Yeah.
Like to see it all go nice.
Yeah.
All right, so we'll wrap up there. Thank you everybody for attending. And I'm sure that everybody's insights have been very valuable. They definitely have to me. I really enjoyed listening to what you all had to say as well. Thank you very much for the questions that you've been submitting over time. Our details, as I said at the very beginning, they'll be sent out after the webinar. So if you have specific questions or you want to discuss your own circumstances, please do get in touch with us. But again, thank you for logging in, and have a great rest of your Thursday.
Thank you.
Thanks.
Thanks.
Yeah.